Markets are calm right now. Stock indices are steady. Volatility is low. Bond markets are orderly. Currency markets are quiet. To most people, this looks like stability. To history, this is often the most dangerous moment. Because when markets are calm during periods of structural change, it usually means risk is being misread, not eliminated. The real warning is not panic. The real warning is when nothing seems wrong, even though the foundations underneath the global economy are quietly shifting. This is how major economic adjustments have always begun, not with crashes, not with chaos, but with calm that feels reassuring right up until it no longer is. In this video, we are going to explain why calm markets can be a warning signal, what has changed beneath the surface of the global economy, and why markets have not reacted yet. Not because they are blind, but because of how modern financial systems process information. This is not about predicting a crash. It is about understanding risk before it becomes obvious. To understand why calm can be dangerous, we first need to understand what markets actually do. Markets are not designed to anticipate deep structural change. They are designed to respond to visible events, policy decisions, earnings reports, geopolitical shocks, and economic data releases. When those signals remain orderly, markets assume continuity. But structural change does not arrive as a single event. It arrives as a slow shift in incentives, constraints, and behavior. And those shifts are notoriously difficult for markets to price in real time. As long as the system appears functional, markets remain calm, even if that system is becoming more fragile underneath. What makes the current moment important is that several foundational assumptions of the global economy are being quietly rewritten at the same time. Not abandoned, not reversed, rewritten. The first of these assumptions concerns central banks. For more than a decade, global markets operated on an implicit understanding. When stress appears, central banks will step in quickly, forcefully, and without hesitation. This assumption was reinforced again and again during the global financial crisis, during the Eurozone crisis, during the pandemic. Markets learned that extreme downside risk would be cushioned. But today, central banks are operating under different constraints. Inflation, political pressure, and credibility concerns have reduced their freedom to act aggressively. They still have tools, but their willingness to use them is no longer automatic. That alone changes how risk should be priced, even if prices have not yet adjusted. At the same time, governments are facing fiscal realities that look stable in the short term but fragile in the long term. Public debt levels are high across much of the developed world. This has not caused immediate problems because financing conditions remain manageable. But the margin for error is much smaller than it was in the past. Small changes in interest rates or investor confidence now have disproportionately large long-term effects. This limits policy flexibility. Governments become more cautious, less decisive, and more reactive. That creates surface stability, but increases vulnerability to future shocks. Markets rarely price this kind of fragility early because it does not show up in quarterly data. Trade and geopolitics add another layer to this shift. Global trade is still functioning, goods are still moving, supply chains still exist, but the logic of global trade has changed. Efficiency is no longer the sole priority. Resilience, security, and political alignment now matter as much as cost. This introduces friction into the system. Friction does not cause sudden collapses. It causes gradual inefficiency, rising costs, and slower growth over time. These effects accumulate quietly. Markets tend to ignore them until they become impossible to dismiss. Perhaps the most revealing signal comes from capital itself. Capital is forward-looking. It moves based on expectations about future conditions, not present comfort. In recent years, large institutions have increasingly favored liquidity, flexibility, and optionality over maximum yield. This is happening even while risk assets appear attractive. That is not panic behavior. It is preparation behavior. It reflects a reassessment of assumptions, an understanding that future conditions may be less predictable, more fragmented, and harder to stabilize quickly. When capital behaves this way consistently, it signals that something deeper is changing. So why haven't markets reacted? Because markets respond to confirmation, not suspicion. As long as employment remains strong, growth continues, and financial plumbing functions, markets assume continuity. This is reinforced by dominant narratives: soft landings, controlled inflation, technological productivity gains, eventual normalization. These narratives are not false, but they depend on conditions that are becoming more fragile. Markets continue to price them because no single event has invalidated them yet. History shows this pattern clearly. Before major economic shifts, markets often remained calm precisely because the change is gradual. In the early 1970s, the global monetary system was already breaking down long before markets reacted. In the years leading up to 2008, credit risk was building while volatility remained low. In both cases, the eventual reaction felt sudden, but only because the warning phase was quiet. Calm did not mean safety, it meant delay. Modern markets amplify this effect. Passive investing, benchmarks, and algorithmic trading reinforce existing trends. They respond strongly only when quantitative thresholds are crossed. Qualitative change, shifts in structure, incentives, and trust, is absorbed slowly. This creates the illusion of stability even as conditions evolve. When adjustments finally occur, they can be abrupt, not because the change was sudden, but because recognition was delayed. Another reason calm persists is psychological. Stability creates confidence. Confidence delays repositioning. As long as markets remain orderly, investors feel little urgency to reassess assumptions. Policymakers face less pressure to act. Narratives of resilience strengthen. This feedback loop can last longer than expected, but once it breaks quickly. What makes the current environment especially complex is that strength and weakness coexist. Employment remains strong, yet productivity growth is slowing. Corporate profits remain solid, yet margins are tightening. Inflation has eased, yet structural costs remain elevated. Markets are liquid, yet risk is increasingly concentrated. This combination can persist, but it rarely resolves smoothly. Trust is the central variable here. Modern economies run on trust in institutions, currencies, contracts, and coordination. That trust has not collapsed, but it has become conditional. Countries are seeking more control over supply chains. Companies are building redundancy. Investors are diversifying exposure. These are rational adaptations to a world that feels less predictable. But conditional trust behaves differently from assumed trust. It makes systems more sensitive to disruption. Markets are calm because there has been no single trigger. But calm does not mean the absence of risk. It often means risk is being mispriced. The real warning is not volatility. The real warning is when markets appear comfortable in an environment that is becoming structurally more fragile. And this brings us to the key question: what happens next? Not in terms of predictions, but in terms of process. And this question of what happens next is where calm markets become most misleading. Because people naturally assume that if something truly important were about to change, markets would already be reacting. Yet history repeatedly shows the opposite. Markets tend to move only after adjustment becomes unavoidable, not while it is forming. What follows in periods like this is not a sudden collapse of everything at once, but a sequence of tests. Tests of policy credibility, tests of institutional capacity, tests of coordination, and tests of trust. And the outcome depends less on any single shock and more on how the system absorbs incremental pressure over time. One of the first areas where this pressure becomes visible is in financial conditions, not through dramatic sell-offs, but through subtle tightening, credit becoming more selective, liquidity becoming more uneven, and risk premiums slowly rising in places that were previously treated as interchangeable. This does not feel like crisis. It feels like normalization. But normalization in a system that has grown accustomed to extraordinary support is itself a form of stress. As financial conditions quietly adjust, differences between regions become more pronounced. Economies with strong institutions, deep capital markets, and policy credibility tend to absorb tightening more smoothly. Economies with weaker buffers experience strain sooner, even if headline growth appears similar at first. This divergence matters because the global economy is interconnected, not symmetrical. Stress does not spread evenly. It moves along channels of exposure, confidence, and funding. Markets often underestimate this until divergence becomes visible in currency volatility, funding costs, or capital outflows, at which point adjustment accelerates. Calm markets delay recognition of this process, but they do not prevent it. Another area where the warning signs emerge is in the behavior of corporations. During periods of genuine stability, companies invest aggressively, expand capacity, and take calculated risks based on confidence in future conditions. During periods of transition, behavior changes. Companies prioritize balance sheet strength, delay large commitments, and focus on resilience rather than expansion. This shift is already visible in many sectors. It does not signal pessimism, it signals uncertainty. And uncertainty, when widespread, slows momentum even without causing immediate contraction. Markets often miss this signal because earnings can remain strong even as underlying behavior becomes more cautious. Labor markets provide a similar illusion. Employment can remain high even as structural pressures build because labor markets are lagging indicators. They respond after conditions have already changed. Strong employment today does not guarantee stability tomorrow, especially in environments where productivity growth is slowing and costs are rising. When adjustments arrive, they often appear sudden, even though the conditions that produced them developed over years. Calm markets encourage the belief that strong labor conditions equal economic health. History suggests that belief is incomplete. Policy responses during this phase also tend to reinforce calm. Governments and central banks prefer reassurance over alarm. Communication emphasizes stability, progress, and control. This is rational. Managing expectations is part of maintaining confidence, but it can also delay necessary adjustment by reinforcing the perception that existing frameworks remain sufficient. Markets respond positively to reassurance in the short term, which further delays repricing. This dynamic is not deceptive, it is structural. Stability is actively managed until it cannot be. One of the most important concepts to understand in this environment is the difference between risk and uncertainty. Risk can be modeled, uncertainty cannot. Over the past decade, markets became very comfortable pricing risk because uncertainty was suppressed by predictable policy responses and abundant liquidity. Today, uncertainty is rising, not about any single outcome, but about the range of possible outcomes. When uncertainty rises, markets struggle. They do not reprice smoothly. They wait. Calm markets in such environments are not signals of safety. They are signals of hesitation. This hesitation extends to global coordination. In previous periods of stress, coordination arrived quickly because incentives were aligned. Today, incentives are more fragmented. Domestic political pressures, strategic competition, and differing economic conditions slow collective response. This does not mean coordination disappears. It means it becomes slower, more conditional, and less comprehensive. Markets tend to assume coordination will arrive because it has in the past. That assumption is increasingly risky. Energy markets illustrate this clearly. Prices may appear stable, supply may appear adequate, but the underlying structure of energy production, distribution, and security has changed. Redundancy has increased. Investment has shifted. Political considerations now play a larger role. These changes increase resilience in some respects, but they also raise baseline costs and reduce flexibility. Markets price current balance, not future constraint. Calm prices today do not guarantee smooth adjustment tomorrow. The same applies to technology and finance. Systems that were optimized for efficiency are being redesigned for resilience. That redesign takes time. It absorbs capital. It reduces returns in the short term. But it is necessary in an environment where assumptions about openness and stability no longer hold universally. Markets tend to reward efficiency. They struggle to price resilience. This creates a gap between valuation and reality that persists until stress tests expose it. All of this leads to a critical point. Calm markets do not mean nothing is happening. They mean adjustment is occurring quietly. The warning is not that markets will collapse. The warning is that markets are comfortable in an environment where comfort is becoming conditional. This does not demand fear. It demands awareness. As this phase continues, what eventually forces market reaction is not necessarily bad news, but inconsistency. Moments when reality no longer fits prevailing narratives. That inconsistency can emerge from modest events, a policy decision that reveals constraint, a geopolitical development that disrupts assumptions, a financial stress that spreads faster than expected. When that happens, markets adjust quickly, not because conditions changed overnight, but because recognition finally arrived. It is important to emphasize that this process does not lead inevitably to disaster. Many transitions resolve through gradual adaptation rather than crisis. But adaptation still involves repricing. It involves redistribution of risk and return. It involves winners and losers. Calm markets delay these outcomes, but they do not eliminate them. For investors, policymakers, and observers, the lesson is not to predict timing, but to understand structure. Timing is unreliable. Structure is durable. Recognizing that the global economy is moving from an era of assumed support and optimization into an era of conditional support and resilience changes how signals should be interpreted. It changes how calm should be read. Calm is no longer reassurance by default. It is context dependent. This is why historical comparison matters, not to claim repetition, but to recognize pattern. Before major adjustments, markets are often calm because the system still works, until it doesn't tee out in quite the same way. The adjustment phase is quiet, the reaction phase is noisy. We are still in the quiet phase. Ultimately, the most significant shift is psychological. Expectations are being reset, slowly, unevenly, and without headlines. Markets will react eventually, because markets always do. But when they do, the reaction will reflect changes that have already occurred, not ones that are just beginning. Understanding that distinction is the difference between being surprised by change and being prepared for it. Calm markets are not the absence of warning. They are often the warning itself.